Good evening, friends. These days, in the evenings, I try to make certain videos which can give you an insight into my thinking. And something I have noticed a lot in the last few days is that on the large indices, which could be Nifty or Bank Nifty, the tradable indices, you know, during the period of March, you had a trending market for 18 days, where from 12,000 broadly, you fell to 7,500. From 23rd, 24th of March, where the markets bottomed out at 7,500, you have been in a swinging market. What is the difference between a trending market and a swinging market? A trending market has very large moves in one direction, very small pullbacks, and then again fairly large action in one direction, directional moves. Now let me tell you about indices. Often you'll see people saying that the index through this year moved only 10%. So what they mean to say is from the previous year's closing, the index moved up by 10% to this year's closing. But within that, it will have several upswings and downswings. Now, it's very important to be clear whether we are in an upswing or a downswing. Now, you all would recall we had a swinging market between 12,000 and 12,400 for about 4 odd months last year. Then that swinging market turned into a trending market and we came down to 7,500. If you open up your charts, we had one swing from broadly 7,500 all the way to 9,900. Then we had a downswing from 9,900 to 8,800. Then we had another upswing from 8,800 to 10,335. And we just finished a downswing from 10,335 to 9,550. Now, why is knowing these swings important? As you must have seen that a lot of people were talking about 92, 9,400 post the 300 point gap down that we saw towards 9,550. Lots of people were calling it a fake rally. Why? Because they are not looking at the market from the prism of a swing. Indices 80% of the time move in swings. Now, what's a swing? Swing is a market going up 6 to 10 days in a row or going down 6 to 10 days in a row. Often in a bullish kind of market, you will have the upswing which will be a bit larger than the downswing. The downswing often will be 50% of the upswing. So from 7,500 we had a 2,500 point upswing to 9,900. From there we had a 1,200 point downswing to 8,800. Then we went to have a upswing of 1300 points from 8800 to about 10,300. That's about 1500 points. And recently we corrected back to 9550, which was a downswing of 750 points. Now if you see between the highs, the previous high was 9900, recent highs was 10,300. So from a high to high basis, you are not gaining a whole lot. So when you are dealing with a channel which has a series of upswings and downswings, each time you come down to the 20-day moving average and you gap down to important supports like we did towards 9550, you have to be ready for the upswing. The problem is that when the markets come down for about 6 days, everybody starts to think that it's a trend. Similarly, when we go up to 10,300, 350, everybody thinks now 11,000 is coming. So the idea is that the upswings and the downswings, the highs and the lows will be marginally higher than the previous highs and lows. So this time I would expect somewhere near 10,400, 500 type of high to be made in this upswing, which means above 10,300 I am not looking for continuation, but I am actually looking for some sort of a downswing to start for some reason. Well, this cannot go on forever. So at some point, what will happen is the market will get into a trending zone. So how do I make out that we are now beginning to trend? Because the market will either make a lower low or will lower high, and that would mean the end of this channel. Or what will happen is, and that happens only some of the time, that we make a 10,500 high, hardly correct 200 points, and then we rocket beyond 10,500. So the idea is when swings turn to trends and trends turn to swings, that is where that should be clear before you come in to trade. Only then you will buy the declines or sell the rallies once it is clear to you what kind of upswing or downswing we are dealing with. Markets trend only 15 to 20% of the time. Most of the time we are dealing with swings. So learn to catch swings and learn to know when things are getting a bit overstretched on either side of the 20 and when there is exhaustion which happens, and generally it happens because of gaps or because of some news. So once you can figure these events out, you will be able to take the right direction on the market, and that will help you because that is the way you buy out of money options, and which tend to work very well if your direction is on the right side of the market. That should be all. Take care, trade well, and please consult your financial advisor.